The past 18 months have reminded us how essential the PC is to work, life, learning, and collecting. And with Windows 11, we have a new sense of the role Windows plays in the world. It offers personal agency and real choice to users. It depends on a path towards the digital mobility. So we have businesses there that really we're going to step by step electrify everything. And what does that mean? Russian areas get electrified. That's 5 days away from the opening bell. Equity futures up a tenth of 1%. 5-day win streak from the S&P into Thursday. All-time highs. That's the price section through the morning calls. First up, City downgrading zero to neutral and cutting its price target by more than 50%. The analysts expecting steep declines after announcing it fixed it from its iBank business. Next up, Argus downgrading Starbucks to a hold. The analysts cited a number of headwinds, including supply chain challenges and rising labour costs. And finally, Goldman upgrading Qualcomm to a buy after quarterly results, forecasting better margins and earnings growth due to momentum in high-end Androids, which are up there by about 12%. Coming up, mounting concerns on your equity market as this equity market rally continues. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars. I think it was hard to put your head around that narrative. Let's just be honest. We've had sort of a shift in early and sort of stagflation fears moment. We're talking about that all day yesterday.
What a winning streak in this market on the S&P 500, 5 days on the Nasdaq, making eight coming into Thursday from the actual way to that rally. Up a little more than a tenth of 1% on S&P 500 futures, advancing 6 on the Nasdaq at 49, advancing about a third of 1%. That's the opening bell. Switch on the board and get to the bond market. Yields coming in 3 or 4 basis points on 10s to 156.47 in the FX market. The dollar is a whole lot stronger against the euro and against sterling too this morning. Euro dollar 115.63, we're negative 0.4% on that currency pair. Outside of that, crude bouncing back again up 2.71%, advancing to an 83 handle WTI, just north of that, $83 and about 10 cents. Let's look at about a flat market in the equity market. Energy bouncing back by 1.1%, top of the pile. Your overall index up by 0.16%. Bottom of the pile, healthcare down a third of 1%, financials off by about a quarter of 1%, and that bond market rally not helping, of course, there either. On real rates, let's talk about it. Luke Cower over at UBS sounding the alarm on real rates and saying the following: real yields may adjust upwards to acknowledge the strong runway for both growth and inflation this cycle. This would likely be positive for our preferred pro-cyclical relative value equity positions. However, a disorderly rise in real yields could challenge equity valuations. For more on this is Katie Lyons. Hey, Katie.
Hey, John. Well, for now, real yields are still deeply negative. You cannot longer be about inflation. You end up with a real rate that is sub negative 1%, negative 103 basis points actually this morning. And that has been largely supported for risk assets, helped us get to the record highs at which we now sit. But if we were to see a spike upward in real yields, that could be a different story. Aspen says most vulnerable could be those richly valued areas that the market. And of course, while real yields are persistently low, we have seen break-evens moving higher, nominal yields moving higher as well. And bonds have been seeing pretty large swings in general. The MOVE index, which is a measure of the volatility in the bond market, has been climbing higher. It's north of 70, heading in a totally different direction than the VIX, which of course gauges equity market volatility. There, we're sub 15. And strategists like those at Bank of America say that can't last forever, and eventually the equity market is going to have to catch up to the signals the bond market is saying about the more not so advantageous policy environment. The thing is, what's feeding the bull thesis is earnings. We have more than 80% of companies surprising to the upside this earnings season. On average, growth is expected to be more than 30% when it's all said and done, but we've already a decelerating earnings growth environment. It's expected to slow even further in 2022 at the same time that policy on the monetary front is normalizing. Mike Wilson over at Morgan Stanley says you add that all together, and the fundamental picture for equities is deteriorating.
Very nice, thank you very much. Working through the real red story. Just want to thank you quickly on what he's performing at his conference over on Threatening Hill Street in London, in the UK. Bank of England Governor Andrew Bailey taking a bit of stick for not hiking interest rates after a strong guide towards a meeting which they said was a live meeting. Some people left disappointed because they did not hike interest rates. 9-member MPC, the vote split 7-2, 2 voting for a hike, 7 saying no. Governor Bailey now cautious on the scale of rate bets seen in markets. That headline dropped about 40 minutes ago. Sterling weaker off the back of all of this, as you might expect, cable down to 135.46. Maybe they're about 1%. I'll work through the Bloomberg terminal with you and bring up the yield curve in the UK. I want to go to the front end of the curve in response to all of this. 2-year gilt yields are down 17 basis points off the back of this meeting. A break of 50 now at 0.496%. No doubt Guy Johnson's going to pick up on this story at the top of the hour. I just wanted to get you up to speed. Taking some real stick at the Bank of England. What they back in December is the unreliable boyfriend back over at the Bank of England. For people who don't remember that, people have become the unreliable boyfriend that will refresh the memory of them a bit. Lafayette College and Chris Mamani warning that equities won't be able to survive rising real yield. Let's get back to that story. Take a listen.
If that happens, the likelihood that the equity market continues to be where it is basically zero. If real rates get that positive, then there'll be hell to pay on the equity market because what we are building in is expectations that real rates are going to remain low for the foreseeable future. One part of it is inflation today, but the other part is rates remaining low for the foreseeable future, even through this transitory period.
And non-transitory fantasy bit, Christian City winding up. Every word of Michael Purvis, Chris Harvey. Chris, this is a perfect way of starting a conversation with you. You said recently, our trading call at tech, on tech, may be at risk, especially across high-octane names. The Fed's anticipated taper announcement this week, announced it, may potentially catalyze a significant directional change in real rates. We believe the eventual real breaking and reversion will be sharp. Chris, on tech, on real rates, walk us through it.
Yeah, so what we've seen this year, real rates go down, tech, high growth, nothing more. Real rates go up, you see the opposite. You see financials, you see cyclicals work. What we're seeing in the marketplace right now is kind of, you referenced it before, we're really seeing now somewhat capped. And so what you're doing is you're expressing your views in break-evens and reals. And as break-evens go higher, reals have to go down more or less. Okay, yeah, nominals will go up a little bit, but really it's being expressed across these two series. And so what we think is happening, right, longer term, the market is worried about stagflation, right? So break-evens go up, reals go down. What we say is stagflation. They think that inflation is going to eat to growth, and that's going to be bad, and so on and so forth. That's going to be pause here. What we've been saying, and we'll see how this works out, is the Fed is an 8,000 pound gorilla, right? When they start stepping out, you should start seeing real rates start to drift higher. They go from the 8,000 pound gorilla to the 800 pound gorilla. If they're not buying or they're not hoovering up all the bonds they possibly can, it should go higher, albeit at a rather slow pace. And that should be good for your cyclical trade. Now, the last thing I would add is the stock market is much more oriented to growth. So if you do see real rates go higher, it is a little bit of an impediment to higher equity prices or very large upward equity prices. But I still think equity prices can go higher in a whole, just probably not as far.
That's the point Krishna Ramani was trying to make in the pushback that came from Krishna. Emily, the idea being that you expect broad equity positive returns from the benchmark, from the index, expecting to have that outperformance from value, and those two things happening together continuously, like it has done through this year, expecting that to persist is unlikely. It's an unreliable story to lean on. Emily, where do you come down on that?
Yeah, so we've been overweight both growth and value in the U.S. this year, and they've really performed neck and neck. Going into next year, we think it's important to emphasize growth. And I want to push a little bit on Chris's argument around rates, because what we've seen in previous examples of Fed tapering is that the yield on 10-year treasuries actually rose when tapering was hinted at, even when tapering began. But then, in both of the last two examples, in 2011 and 2013, we actually saw yields fall because investors got concerned that the Fed was pulling away the punch bowl, and they actually raised the safety of the 10-year treasury. So if your argument is that growth stocks, aren't going to do well as rates back up, we really don't see that. We actually see this decelerating growth environment. John Matheson and I have been coming on your show, for the last 6 months, saying that we thought that the high in the 10-year treasury was already in for this cycle at 175 back at the end of March. We think it chops around from here and ultimately, does move lower as this economic backdrop, while still positive, continues to decelerate into next year.
You, Matt Mexican, Francis Donald as well, all lining up saying the same thing. I hear you, Emily. Chris Harvey, your name check there, your response.
I think Emily says, I agree with a lot of the things that she said. If you look into 2022, you do want to have a higher growth approach. But our point is, what's really driving equity markets and relative pricing is what you're seeing in the bottom. And really what's driving it is real rates. So as real rates go up or go down, you're going to have a reactive behavior. Are rates capped, and are they capped? That's a longer discussion. We think that we have 36 months for this cyclical trade, yes. After that, we get a lot more nervous, and we think that higher quality doesn't make sense. But in the short term, you can see the cyclical trade work. You can see many things work. Again, we think equities will go higher, but you have to be worried about the second half of 2022, and probably starting in the second quarter of 2022.
Michael Purvis, picture together. Go on, Mike.
So just a different facet of this discussion is what happens with the dollar. If Luke is right and real rates do jump up here, How roughly does it happen? What level does it happen? So, what we've seen since, from several years, but really since March of 2020, is Powell's been very focused on the dollar, making sure that it tightens as not as strong as possible. We've seen some dollar strength this year, right? Commodities have been rallying broadly, and the dollar has been rallying too, and a lot of it has to do with real rate differentials between, say, Europe and the United States. So if yields over here jump, 50 basis points here, that's going to be an issue for the Fed, and it's going to, sort of, I think, get back a much more dovish narrative, and even more dovish than what we've been seeing. So I guess that's to wrap things up. So get me to jump in here. You're very constructive on this equity market. Emily Rowland is a lot more cautious, wants to be nimble. Chris Harvey, very, very cautious going into next year compared to the amount of theory is coming to year end. When Emily Rowland talks about the deceleration we're expecting next year, when Emily Rowland talks about what she calls the end of earnings nirvana through next year, do you disagree with those points? Are you just thinking the market responds to them differently? Which one is it? Look, I think phenomenal GDP setup, the confidence is going to drive S&P top line and bottom line is still very strong next year. There's no question that peak acceleration is in. I mean, it's Q2 is locked, right? I think we know that, right? But the nominal GDP story for next year and into 23, I think is still going to be pretty good. A lot of supply chain issues that the value sector are going to spill over, are going to reinforce a better growth profile next year. If you didn't buy your Ford 150 this year, you'll buy it next year and so forth, right? So I think there's that story. And by the way, if you go back to every time that you've had a surge in earnings growth, like we did in this past summer, on a 12-month forward period, the last 4 times, it's only been bad was back in 2000, right? The last 2 times we've had a surge in earnings growth. Deceleration doesn't mean bad market performance. Obviously, you need growth, but it has to be growth that the market's comfortable. And again, you get back to bond yields, and it's going to really reinforce the buying digit into 22.
Let's finish here then. I mean, I'll give you the final word on all of this. Why is it the rate of change you think is more important here and not the absolute? If we had a 4 or 5 handle on GDP next year, why is it the rate of change was so important to you and not the absolute?
I love it when you give me the final word. So it's really important here to keep in mind that this cycle is moving quickly. And we all need to remember that the cycle never dies of old age. It's killed by the Fed. So the Fed is in between a rock and a hard place right now. The 210 spread is sitting at about 100 basis points right now. Typically, it's about 300 basis points the last couple of times that the Fed raises rates. So they're in a really tough position. If they decide that they've got to respond to these inflationary pressures that seem to be more persistent, that is going to quicken the cycle even faster. This is not a great time to load up on cyclicality in your portfolio. It's a really important time to be more thoughtful and embrace those higher quality areas in the market.
Thank you. You can have the final word whenever you like. Chris and Michael don't mind. Chris Harvey, Michael Purvis. Guys, thank you very much. Appreciate it. Coming up on the program is the US versus OPEC. Front and center. Crude up by about 70% year to date. And this administration wants OPEC to do something about it. That conversation's next. This is Bloomberg.
Television and radio. We are on the verge of a disaster. Join us live from Glasgow for coverage of the COP26 Climate Change Conference. People are continuing to build some momentum, I think, but there'll be enough. We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you. We're going to need to see some real action. COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
очень много думал о том, что я сделал, и понял, что сделать какую-то нереальную вещь. Не знаю. Я до конца как бы внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком я хотел сказать, что только через действие в жизни достичь можно абсолютно всего. I say that we can basically do more for ourselves. We've been energy independent for the first time in 67 years. Why can't we do more? Why can't we produce more? We've got plenty of natural gas in my state, beautiful state of West Virginia has an ocean of natural gas under it. If it just let us build a pipeline, we could get the product to market. And why don't we do more drilling? And why don't we do more basically production in the United States? I'm not depending on OPEC. I'm not depending on other countries for my energy anymore. We know how to do it. We have the technology. We should be resilient, relying on ourselves. A really interesting interview with Senator Manchin there and Brett Barrows on Fox News yesterday evening. The President of the United States is blaming OPEC Plus for the rally we've had in crude this year, remove the say 70%. He thinks that the Saudis and Russia should do more. Senator Manchin saying we can do stuff at home. Other people agree with him. We can invest here in America. We can do something with the pipeline, but they were the decisions that this administration made to disincentivize investment at home. But for some reason, once crude starts rallying, it's someone else's problem. It's OPEC Plus, it's Russia, it's Saudi. Crude right now, 82.89 on WTI, 84 on Brent. With us is Will Kennedy over in London. Will OPEC Plus fold?
Bit too early to say, but the preliminary indications are that perhaps they won't. We know that they have been presented with some requests by the US to perhaps go twice as fast as not, go to 800 rather than 400. But from what we hear, there isn't that much discussion of that happening. They're still meeting, it could change. We should hear what's going on in those deliberations shortly, but it does look as maybe that the president of OPEC heading on a collision course.
Well, interesting to look at the collision course at home here in the United States of America. If you could compare and contrast the comments there from Senator Manchin with some sound of the president earlier this week, the difference would be stark. Senator Manchin saying we can do more at home in America. The president saying this is about OPEC Plus, it's about Russia, it's about Saudi. For someone like you who can strip all the politics out of this, Will, when you look at this from purely a commodity, a market perspective, what's your take on what's happened with energy this year?
I mean, the big story here, and this points to some of the things that Senator Manchin was talking about, is that shale is the dog that hasn't barked in our market this year. We've seen prices rally 7%, as you said at the start of the segment, John, that so far shale, which over the last 10 years has really been the barrels that have come onto the market to keep prices suppressed, they're holding their line. I mean, there's a bit of extra production from the Permian, but it's not a huge amount. And that's really what's dominating the market here and allowing OPEC to just take turns.
What do you make of the pipeline issues in the United States? Well, do you think that's made a difference?
I don't think that it's necessarily made a difference in the short term. I think longer term, I think the trade is clearly was giving decision that new pipelines are incompatible with the climate goals of the Biden administration wants to reach, and it will eventually keep some fossil fuels from the market. It's going to be controversial. There are going to be people who are more pro fossil fuels because those pipelines need to be built. Are going to argue that that's part of the fight fix, that I don't think in the short term
expenditure value this year.
Well, the SPR's back in the news here in America. Helena Croft, I'm sure you know well, over RBC Capital Markets, has said we think the Biden administration is prepared to release crude from the Strategic Petroleum Reserve in an effort to cap prices. And I just get a final word from you on that, Will Kennedy. On the SPR, just to repeat that quote again, we think the Biden administration is prepared to release crude from the Strategic Petroleum Reserve in an effort to cap prices. What say you, Will?
Biden, if he gets rebuffed by Saudi Arabia and West Arabia, is going to have to respond. And I think the consensus is that this is one way that he can respond and look like he's not taking no for an answer and actually have them prices. The problem he has is if you do it once, is there an expectation you have to do it again and again?
And at 80, well, does that surprise you? Just a final word on that. Has it surprised you that we're doing this at levels that aren't historically incredibly high, given recent years?
Yeah, but I think that's right. I mean, we see prices well over 100, and we saw over 100 for a sustained period in the 5 years after financial crisis. However, I think what you need to be looking at is gasoline prices in the US, which are at a very elevated level, 7 years high, clearly a big problem for the administration.
Well, good to see you. As always, Will Kennedy there, out of London on this commodity market. Brent crude 83.92, up more than 2%, bouncing back from yesterday. WTI 82.73, up 2.34%. We've got a record high in the secondary market. Breaking it down, our stock setter today, Wilson. Hey, Dave.
Hey, John, you're going at 5 of the 11 main industry groups in the S&P 500 higher, but there are some key groups leading the way. And energy, you were just talking about what's going on with oil prices. That's certainly helping. You look at the consumer discretionary category, you have to remember it's a pretty broad lineup of stocks. So, we're seeing some well-received reports from a number of companies that are just helping that group move higher. Even the arts and crafts marketplace, Etsy, is contributing to the game. Technology stocks doing relatively well. On the other side, financials, the worst performers on the day among the 11 main groups. Within technology, we're focusing more on the chip makers. We had results out of a couple of them late yesterday, and you see the shares move in opposite directions. Qualcomm up almost 14%, while Qorvo is down almost 14%. Thing is, though, Qualcomm a much bigger company, so what you're seeing on balance with the Philadelphia Semiconductor Index is another gain, which would be another record. If it holds up, it would be the 6th straight advance for this game, and it would match the longest streak of gains this year.
Dave, when are we done with earnings season? How many more weeks? Are we done?
Well, we're close. I mean, you kind of get to the point, John, where it's media companies, we've seen some of those with Viacom, CBS, and Fox. And then, the retailers kind of straggling in because for most of them, fiscal calendar is a month behind the actual calendar. So we'll get those results over the next couple of weeks.
Great to have you with us, Dave, as always. Dave Wilson. So leading on his expertise, his history of this company as well. Dave Wilson, thank you, sir. Our stock editor. Your equity market for 6 straight days now is higher on the S&P 500, a 6-day winning streak. All-time highs in the equity market. Longest winning streak since October 21 of this second. The longest winning streak of the year so far, though, on the Nasdaq 100, it's 9 days now. The longest winning streak since December 8th of last year, 2020. The equity market record highs across the board. Up next, the market moving events you can be watching. I'll bring you the trading diary, the guide into the weekend. Payrolls around the corner. From New York, this is Bloomberg. I was just watching what you were saying, so the decision has people got confused. I will, just one more story. So we're at 137 right now. It's a weakness. Is this where they play the music? Is this it? What they no charges. All the music. Amazing stuff.
Do you see Israel ready to really more? Is there more to the goal to push back to have a strong target? That's where you want?
Well, if we look at it has been, in other cycles before, it is now. We're finding that we're competitive in that work account.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
25 minutes into the session, here's the equity market. Another day of gains on the S&P 500, 56, up a third of 1% on the Nasdaq. Another all-time high, up a half of 1%. That's the equity story. Switch at the board and get to the bond market story. Not just treasuries today, but gilts as well. The front end of the yield curve in focus. We're down 4 basis points on twos in the US at 42 basis points. Talking a lot about Chairman Powell. Talk a little bit more about Governor Bank in the UK. When you have a monster move at the front end of the curve, like we've got today over in the UK, something's gone wrong. Now, I don't want to validate this idea that the bond market needs its hand held all the time, but if communication's that off with the market and you get a move that big, something's gone wrong with communication at some point. That's the bond market. Let's get you the trading diary. The events you need to be watching through the week, into the end of the week, it's about payrolls, the report coming tomorrow. Powell, Parker, Evans kicking off a big week of Fed speak on Monday. CPI numbers out on Wednesday. Plus, we'll get Disney earnings, the US bond market closing for Veterans Day on Thursday. And finally, the University of Michigan Consumer Sentiment Survey coming out next Friday. Not tomorrow, but next Friday. The focus tomorrow is very much on payrolls Friday. Looking ahead to tomorrow, 450k is your estimate. The range is wide as ever. 700k at the low end, at the high end rather. At the low end is 250. I'll bring you the payrolls report tomorrow on Bloomberg TV from New York City. Thank you to Bloomberg.